Hi, good evening, everyone. Welcome to this webinar session. This is a continuous webinar session that we've been doing at Global Investing. The goal is to educate you as users or potential users of Global Investing on how do you start building a portfolio and how do you start investing in US markets. So this is part of our ongoing series. This is the fourth webinar that we are conducting. Today, we wanted to pick up two slightly different themes. One is talk about benefits of investing in US markets, which we'll brush upon some of probably the things that we've spoken about in the past, and also introduce you to a concept called thematic investing, talk about the basics of thematic investing, how it works, and how can one go about building a thematic investing portfolio. More specifically in the US market context, but the thematic investing principle can be applied to any market globally. So I'll start off on the first piece, which is about benefits of investing in US markets. As most of you would know, US markets are home to some of the largest companies in the world, some of the leading businesses in the world. They're all listed on US stock markets. So US stock market becomes the obvious choice when someone is going to start building a global portfolio. But then the primary question is, what are the numbers pointing at, right? Because we're all data-driven people. We want to understand what are the numbers pointing to, why US market is very significant. So let me look at some of the statistics here. So the first statistic that came to my mind is in terms of the US market versus rest of the world. So if I were to give you a cricketing analogy, which all of us love in India, right? Let's say you want to build the world's best cricket team. And then you were told that, 50% or 50% of the players in the world, top players in the world are not available to you to build the team. What sort of a team would you be able to build? So draw that same analogy in terms of your portfolio now, and think of it this way, that the top 50% of the companies, that US market cap accounts for more than 50% of the world market cap. It is close to 54%, which means that if you really want to build a diversified global portfolio, then US market is an obvious choice. You can't ignore the US market and build a globally diversified and meaningful portfolio. That is what this statistic, and this is a fairly significant statistic that came to my mind. The second is in terms of the stock exchanges, because we are all familiar with probably BSE, which is at the bottom of the list in this sequence. But we are also familiar with stock exchanges in other Asian markets like Japan, Hong Kong, China. We're familiar with markets in European countries. But just to put the numbers in perspective, just look at this chart, right? NYSE and NASDAQ together account for more than the rest of the exchanges all put together, which means that NYSE has a total market capitalization. All companies listed on NYSE have a market capitalization of $21 trillion. The NASDAQ also comes very close to that $21 trillion. And you look at the third largest stock exchange, which is Japanese stock exchange, it is just $5.7 trillion. So even if you add up the next 10 stock exchanges globally, they don't equal the power of NYSE and NASDAQ put together. And that is just in terms of numbers. I just wanted to set the context of why one needs to invest in US stock markets, because if you don't invest in US stock markets, you'll be missing out on these top listed companies in NYSE and NASDAQ. The second point is in terms of performance. We look at the last 3 months, 6 months, 1 year, 3 year, 5 year, and we did this exercise over extended periods of time. You can pick a 10-year, 15-year horizon. You will see that the S&P 500 index is, we are talking about the Sensex because that gives us an Indian context. But if you look at it globally, the S&P 500 has beaten most global indices. And it has clearly beaten the Sensex in the most recent performance as well as in the 3-year, 5-year performance. This was updated as of June 5th. The second interesting piece is in terms of the currency gain. So if you look back about 5 years from now, right, the USD INR currency exchange rate was at about 63 rupees to the dollar. Today it is closer to 75 rupees to the dollar. So your portfolio is not just growing in terms of absolute gains, but it is also growing. The currency gain is also helping you build a better performing portfolio. I think this is the slide that I wanted to summarize all of the points in terms of investing in US markets and what you get by investing in US markets. We spoke about portfolio diversification, which means that you get access to a diverse range of instruments in the US market. You get access to a bigger market, which is very obvious in terms of size. We looked at some of the numbers, the 54% of the world capitalization and the $21 trillion capitalization of listed companies in Nasdaq and NYSE. So obviously it gives you an access to a bigger market. We spoke about currency benefits, and it's not just over a 5-year horizon. If you were to pick at any horizon, a 10-year, 15-year, 20-year horizon, and these are typically the horizons that one should think across when you're investing, building a US equity portfolio. The currency gain, the INR is differentiated against the USD, which means that your portfolio is benefiting from this INR depreciation. There are huge liquidity advantages. We spoke about the size of the market. There is a very active order book for most of the stocks that are available on the global investing platform today. These are mid cap, large cap, small cap stocks, but highly liquid stocks, which means that there is a very healthy order book for this, and there is an available transactional market for this, which is very important as an investor for you to discover the true price of a stock. The next point is higher shareholder yield, which means that these efficiency, finally what they lead to is a higher shareholder yield, because as a shareholder of the company, having a better price discovery mechanism, having a better currency exchange rate, all of them help in building a better yield for you. There are obviously some of the softer aspects which I've bucketed under structural edges. So to talk about some of these aspects, right, in terms of transparency of reporting, so to speak. So SEC, which is the equivalent of the SEBI in India, for example, has something called as insider trading reporting, which means that in close to real time, they report the transactions that insiders in the company. Insiders are deemed to be people who have access to privileged information. This could be the board of the company. This could be the management of the company. That what are the transactions that they are doing on the stock. So this, as a retail investor, this benefits you by having that information. The SEC also sets very stringent guidelines in terms of reporting structure for companies, in terms of any listed company, what are the metrics, operational metrics, financial metrics, business metrics that they need to report. This results in higher transparency. And we'll also talk about some structural edges, like in terms of insurance provision. For example, as a retail investor in the US market, on day one, you get an account insurance of $500,000, which is $500,000. This is on day one without having done any investment. And this is a mandate by the US government that every retail investor should be provided this insurance. And the program is managed and run by the US government. So it is backed by the US government. So these are some of the softer aspects of which give you more comfort as a retail investor, that I've clubbed under structural edges. The one more obvious thing that all of us are getting more and more aware of, if you look at all the brands listed over here, I'm sure that all of us on this call are consumers of at least, if not all of the 8 brands, but at least I would say 4 or 5 of the 8 brands. We are end consumers of these brands. And now we want to start investing in world's leading companies. And just to put it in perspective, it is not as if all these leading companies decided to, list in US stock markets. US as an ecosystem has a very strong funding mechanism for early stage ventures, which means a lot of technology innovation happens in the US market. This results in a lot of shareholder value creation. So today, for example, if you look at companies like Apple, Facebook, Amazon, Netflix, while by themselves they're very large market capitalization companies, they've shown some really tremendous innovation in terms of the consumer story. The question is, given the rapid growth that we've seen in the last 3 years, 5 years, 10 years, is it the end of the story? I would say not at all. It is the beginning of the story, just because of the innovation ecosystem that they're present in, either through acquiring innovative startups or by having in-house teams which are very innovative. Each of these companies are looking at how do they grow 10x from here, how do they grow 100x from here. And by investing in these companies, you get an opportunity to grow your portfolio by that same valuation. And typically, I like to quote Warren Buffett, who had a very value investing driven approach to managing a portfolio, to say that, sure, these are leading companies in the world, you can bet on them, but you need to be careful on how you bet, because markets can have their up and downs, which means it is very important to have a proper portfolio selection process, and it is also very important to manage the time horizon. And this proper portfolio selection process is what leads to our next topic today, which is typically around thematic investing. So thematic investing, put in very simple terms for you to understand, it is nothing but it enables you to invest in long-term trends or investing in themes. Which means that, let's say today you believe in a certain theme is going to play out, whether it is a consumer spending story or whether it is a pharma and biotech story, given the recent COVID-19 epidemic that we have seen, whatever theme you believe in. The question is, how do you translate this theme into an investment strategy and how do you translate that investment strategy into an actual portfolio. This is all that thematic investing put in very simple terms is. So you benefit from market trends and investing themes, like I spoke about. If as an investor you have identified a theme saying that I believe this is the way the world is going to grow in the next 1 year, 3 years, 5 years, then based on that theme, how do you have a very systematic approach to investing, which means that how do you not bring in your own personal biases, but how do you do a lot of research and analysis to build a portfolio around this theme, and how do you manage that portfolio on an ongoing basis. So to simplify it, to put it in very simple terms, I usually have a very simple three-step approach, what I call as a three-step approach to this. First is very simple: identify the investment strategy or the theme, which means that identify the investment approaches that have been tested over a long period of time. Now, when people talk about, I spoke about value investing when I was referring to Warren Buffett. People talk about approaches like a multi-factor approach. People talk about twin momentum strategy. So these are all different approaches that you have, and you need to have studied these approaches and have a belief saying that this is the approach that is going to work. Or the other option is you need to have an investment theme, which means that you believe that, for example, productivity tools, which has been a trend in the US market in the last 3 to 4 months, since a major chunk of the working population is now working remotely, productivity tools have come into a focus. So you need to have a belief that this is a theme that is going to play out. So how do I invest around this theme? That is the first step of it. The second step is it talks about constructing computerized models, but not necessary that it needs to be a computerized model. It can be a simplified form of the model as well. But computers typically help you churn through a lot many more data than you can do manually. So it's always important to have computer assisted models, at least if not fully computerized models, where what the model does is, now that I believe in this theme and now that I have put certain parameters to the theme, the computerized model will help me identify, sort through, let's say I have a universe of over 3,000, 3,500 stocks that are available in the universe of stocks in this theme. How do I narrow it down to a set of stocks based on certain parameters? And these parameters, typically people think in terms of value, people think in terms of growth, people think in terms of risk. If you were to broadly classify the 3 parameters, right? How much value am I going to derive by investing in this? How much risk am I taking on, and how much growth am I going to see by investing in this model? So based on these parameters and your tolerance for these parameters, you can adjust these models so that your universe gets reduced from the thousands of options that are available there to a few hundred or a few 10 stocks that you want to invest in. Now, the third piece is very important. I think it's something that all of us understand in theory, but very important to keep in mind, which is to continuously review this. And when I say continuously review this, it doesn't mean you keep looking at the stock price or you keep looking at a portfolio value 10 times a day. That is not what I mean by continuous review. What I mean is that you need to understand what is your underlying theme and is that underlying theme playing out. While some of it might get reflected in the stock price of the companies that you've picked, some of it may not. It may take a longer time horizon to play out. But it's important to continuously review your investment thesis and hence your portfolios to see that this investment thesis is playing out. There is always a need to rebalance or churn your portfolio, which means that you will have to keep adjusting for certain companies which you believe are either reach their growth potential based on your initial theory. So you can start booking some of the profits on those companies, or you believe that the company has changed direction as of now, let's say 6 months, 1 year, 2 years down the line, and hence this company may not be relevant for your investment strategy or for your investment theme, and hence you want to drop it. Or there may be new companies you have listed in the market that you want to add to the portfolio. So the third step is equally important, which is ongoing review of your portfolio, rebalancing the portfolio, and continuously repeat this process over a periodic time frame. Now, taking the sample approach, now some people may say this is a very theoretical approach, but let's take the same sample approach and actually try to build a real life portfolio out of it, which we at Global Investing have actually done. And we will be launching these thematic portfolios very shortly on the Global Investing platform as well. But let's take the sample approach. And I thought today we'll discuss one such strategy as well, which is theme based. So the strategy that I picked for discussion today is the electric mobility strategy, for example, right? Let's take electric mobility as a theme. Now, why is it that we believe in electric mobility as a theme? There are 3 very broadly, if I were to classify it, very broad trends that are happening in the market that we observe in the market, which we believe will drive much faster adoption of electric vehicles in the market. One is technological advancements, whether it is in terms of battery power, whether in terms of battery storage. Technological advancements are making sure that electric cars are becoming more and more affordable. Second is there is a clear policy shift, and even in India, you will see that emission norms are getting tighter and tighter. We have moved from the BS4 to the BS6 norms recently. So globally, that is a pattern that we're observing, where policymakers are pushing the auto market towards more and more stringent emission norms, which means that the only solution would be electric vehicles. The third is the automakers also are clearly identifying a part of their portfolio as being electric vehicles, and they are investing heavily in this segment. So these key trends help us believe that yes, our investment theory of investing in electric mobility is valid. Then we further validate this theory through some numbers. For example, you look at the market growth overall. For example, it's expected that the market itself is going to grow at 25% CAGR, which means that if blindly, even if you didn't pick any of the underlying stocks, and let's say tomorrow someone came and offered you an electric mobility ETF, so to speak, which invests in all the stocks which constitute electric mobility, which means that that portfolio alone would grow at 25% CAGR. Now, obviously, within that, there would be segments that one would be interested in. That is how you build a thematic portfolio. But just the CAGR of 25% at a very broad industry level is very attractive for one to start looking at a thematic portfolio approach. The market size, the absolute market size is close to $500 billion is what it's projected to be in the next 6 years, which is a very attractive market size, which means that there is still scope. What happens is if it's a large enough market size, there's still scope for having a bit of pluses and minuses in your portfolio. Because once it comes to stock selection, you may not be able to hit the right selection parameters right up front. But then there will be enough opportunities in a large enough market for you to churn that portfolio and identify winners eventually. And the third one is the more shorter term trend, where in the calendar year 2019 alone, we saw that the fleet of electric vehicles globally more than doubled. The beginning of 2019, it was 2 million cars, and at the end of 2019, it was 5.1 million cars. So it grew by close to 1.5x times, right? And that is where we see that the trend is playing out in the shorter term as well. So now that once you've established saying that electric mobility is a theme, sure, I'm interested in, I've done a little bit of my market research, I've done a little bit of my data gathering. So I've validated the theory saying that. So if I go back to my previous slide, I validated the first piece of it saying that my investment strategy and investment theme is something right that I'm considering. The second step is how do you build the models? So the first thing is you have to look at the entire value chain, because typically when we talk of electric mobility, the only answer that people have is Tesla. Tesla is not the only company. Of course, Tesla stock has done very well in the recent past, but Tesla is not the only company in the electric mobility value chain. You have to look at it across the value chain of automotive manufacturers, of battery makers, of charging infrastructure companies, which is a much needed infrastructure support for this market to grow, for consumer electronic companies who are building critical components, for technology solution providers end to end. So these are all interesting spaces to be when you think of electric mobility as a theme. Now, just to iterate further on the sort of process that we followed, right? For example, we identified over 100 companies across all these stages of the value chain. And from there, we did a short list of the companies based on 3 broad parameters. One was on valuation, one was on financial health, one was on growth stability. So we narrowed down the companies based on three parameters. We did some amount of statistical simulation, because even though now I know that based on, let's say, my valuation parameters, my financial health parameters, and my growth stability parameters, there is a universe of 15-20 stocks. But there are 2 things that one has to be very eager about. It shouldn't be that all the 15-20 stocks are all the battery makers, right? Then what happens is you're then again concentrating your portfolio, which is the point around correlation assessment, that you should make sure that your portfolio, while you're investing in a theme, is diversified enough, which can be across the value chain of electric mobility. Within each step of the value chain, you need to make sure that you have enough diversity. So it's very important to make sure that your final pick of 10, 15, 20 stocks as part of your portfolio, they are not all very tightly correlated, because otherwise what will happen is either all of them will do very well at the same time, or all of them will do very poorly at the same time, which is not what you want from your portfolio. You want your portfolio to perform better than the market in an up market and not lose as much as the market when the market is going down. The other thing to do in these scenarios is to do a stock price simulation. This is basically in very simple statistic and machine learning technique. This is called as the predictive ability of the model that you built. What this will help you do is to say that, let us say, how much predictive power do you have in your modeling technique, which means that I may have identified a great set of companies, but but most of your valuation, financial health, growth, stability may be on past performance. The question is, how much of predictive ability do you have in your modeling, which means that with what accuracy am I able to predict the future? Now, how does one model that? In very simple terms, what you can do is you can do something called as a back testing, which means that, let us say, you process all the information that was available to you as of the end of calendar year 2018. How accurately were you able to predict the 2019 prices of these stocks? That is one validation of saying what sort of predictive ability your models carry. So it is very important to have models which have a good predictive ability, because finally we are interested in the future value of the stock, not in the past value of the stock. It is important to have a portfolio that is reasonably diversified in this case, which correlation assessment will help you establish. The third piece that I want to talk about is the simulation runs, which means that now that you have identified these companies, which is that the portfolio creation is typically a two-step process. One, you have to select the stocks and you have to allocate to these stocks. The selection, once you have done based on all the description that I have given, in terms of allocation, typically the approach is that it depends on what is the parameter you want to optimize for. There are three broad parameters that any investor would like to optimize for. One is value, one is growth, and one is risk, like I said. In terms of growth, I can optimize for CAGR and say that I want a portfolio allocation in a way where I want to have the best returns in the next 3 years, 5 years. But one should remember that best return, higher returns will also mean higher risk. Or as an investor, I can say that I want to optimize for lowest possible risk. I don't, even if I get moderate returns, it's okay, but I want a lower risk. Or as an investor, I can say that I want to optimize this portfolio for something called a Sharpe ratio, which is, excuse me, some issue on the connectivity side.
Well, we can hear you. You can continue.
Yeah, I'm sorry. I just lost the, yeah. So this is the last slide that I was talking about. So there are three, like I said, the portfolio optimization piece, there are three approaches to it. One is growth, one is value, and one is risk. So you can say that now that I've selected this universe of stock, in terms of allocation, I want to have a bias towards very high growth potential stocks. Or you can say I want to have a bias towards very low risk stocks. Even if my growth is moderate, I'm okay. Or you can say that I want to have a balance between the two. There are enough financial parameters. A very simple parameter is something called as the Sharpe ratio, that most of you will be aware of, saying that it measures the risk return trade-off of a portfolio. So it will tell you for a given amount of risk, how much excess returns are you able to generate, and hence is it worthy to take on that risk. So you can optimize the portfolio for these sort of parameters as well. So like I said, going back to the thematic portfolio construction methodology, these are the large components to remember when you're building these portfolios. And the thematic portfolio, I hopefully has explained to you how one constructs a portfolio in a real world based on the theoretical approach that we have. So I think those were the two large topics that I wanted to touch upon today, because this is a very exciting product that we are also working on as we speak, and we will be launching these thematic portfolios very shortly for the global investing audience. We are in the final stages of the product launch, so very shortly we should be able to launch this portfolio. I just wanted to make sure that, as existing customers or potential customers of global investing, you're aware of how, typically one goes about building these thematic portfolios. So I'd be happy to take any questions at this point in time. I think I was told that I'll be getting the questions over WhatsApp. So let me have a look at it. If there are any questions, I can start addressing those. Yes, I do have a few questions. Let me read them out here. Okay, the first question is, it says HDFC Securities suggests us Indian shares that we must buy with gain timelines. Why can't they do the same for US stocks, since we could benefit from the analysis and will help us buy the correct shares? I completely agree. The first step towards any investment process is first to have the infrastructure and the market access put in place, which is what I think HDFC Securities as a leader in the space has done by providing the global investing platform. And we as part of the global investing team are working on the logical next step, which is to start offering more guidance in terms of more information. I would say more information in a very processed and in a very clear way that you as an end investor can digest, and which will help you make these investment decisions. So this is something that we are completely aware of. We are working on it. And like I said, the thematic portfolios that we will be launching very shortly is our first step towards that. Let me take the next question. I think someone mentioned about the insurance point that they did not understand. So I think the insurance that I was mentioning was in terms of the structural edges that the US market offers you. It is very simple. So today, for example, I think most of you in the Indian context are aware of what happened with Carby as an institution in the Indian context, right? Think about it. If that happens to your US broker, what is the fallback that you have? That is what I was talking in terms of insurance, saying that tomorrow, let us say something happens to your SEC registered US broker dealer that you are working with, for whatever reason. It may be a large brand name that it could happen to, it may be a smaller brand name, but if something happens to that company, the fallback that you have as a retail investor in the US market is this insurance scheme that is provided by the US government. So as soon as you open an account with Global Investing, that account is covered for $500,000 or $500,000 worth of insurance that the US government provides you against any issues or any consequences that you have with your SEC registered broker dealer that you're dealing. The next question is, does HDFC mutual fund have international investment fund? Well, HDFC today doesn't have an international fund that it offers, but on the HDFC Securities platform, you have other offerings of international mutual funds that are available. A few of the famous names in the Indian context are, there is a Motilal Oswal fund that's available, and there are a couple of others, the Parag Parikh fund that's available, which are some of the more popular funds that are available. But having said that, you have to understand that the purpose of each instrument is very different. So when you talk about a mutual fund, when you talk about an ETF, and when you talk about a thematic portfolio, these are, you can almost say these are three very different asset classes, and one has to understand the context of each of these. A mutual fund is basically think of it as an instrument where a fund manager, a professional fund manager, is sitting over there managing your portfolio and deciding what sort of an investments to make. So you are obviously, there are costs associated with having this sort of a professional setup, that these costs are typically passed on to the investors of the mutual fund in terms of the expense ratio. And then there are obviously churn related costs, which means whenever a portfolio rebalance happens, there is a transactional cost that are there. And mutual fund schemes, typically as an end investor, you don't get to decide which stocks should the mutual fund invest in. That is completely in control of the fund manager, which means that in the mutual fund, it's, think of it as a black box solution where you completely believe in the fund manager and the approach, and you invest that money over there. Beyond that, you have no say in it. There is certain costs associated with that, and there are some returns that you get from that. That is a mutual fund platform. The second is an ETF platform, where it's an exchange traded fund, which means that it can follow the underlying investment, can be an equity index, it can be a commodity, or it can be a fund itself, but it is traded on the exchange. So which means that in real time you can buy and sell these instruments. That is the big advantage of ETFs. And also, given the computerized mechanism in which the ETFs work, the expense ratios are also much lower than mutual funds when an ETF goes. The thematic portfolio is something completely different, which means that you have now identified a theme or an investment strategy, and you want to build a portfolio towards it, which is a very active way of managing it, which is very different from a mutual fund, or from mutual fund is more like a vehicle. Thematic portfolio is more an approach, so to speak. Okay, let me take on the next question. So how will I invest in US stocks? What is the process and what is the minimum? I think there are a couple of questions around that in terms of how to invest in US markets. So I understand that I've spoken about why to invest in US markets upfront in the presentation. The reason I didn't cover how to invest in US markets is we have a previous webinar that we had done, which talks about the end-to-end step-by-step investment process. How do you go about opening an account on the global investing platform? And our endeavor with the global investing platform has been that it has to be a completely retail customer oriented platform, which means that as a customer who's sitting in his living room in his house, he should be able to open a global investing account online, he should be able to remit the funds online, and he should be able to invest online. To that extent, we have made it a very simple to understand platform. We have made it a DIY or a do-it-yourself platform. So I would urge each one of you to go to hdfcsec.com/global investing. We do have an active support, or we support on chat, we have support on phone line, we have support through email. So if you have any questions around the process or that, please feel free to reach out. There is also a previous webinar that we had done, one of the early webinars when we had launched this global investing platform, where we spoke about the entire end-to-end process on how to set up the account. I would request you to go and look at that as well. Okay. So I think the next question is also related to the process. There are a couple of questions related to taxation. So, and since taxation is a slightly lengthier topic, I'll touch upon it towards the end of the seminar. The next question is how to select the best performing theme. Now, see, the theme-based investing is typically, like I called, it's an approach-based investing. This is like asking, how do you select the best team in IPL? To draw my favorite analogy in terms of cricketing teams, right? Past performance is one indicator. Second is the approach or the manager and the captain and how they put it together. The third is what is it that it's investing in, how are each of the underlying stocks performing. I spoke about value chain. So in my cricketing analogy, you can think of it as how many all-rounders do you have, how many batsmen do you have, how many bowlers do you have. So finally, there is no right or wrong in a thematic portfolio approach. The fundamental questions, you have to believe in that approach, you have to believe in that theme, and hence invest in the theme. You can't go purely by past performance numbers, because take, for example, one of the themes that has emerged recently is a SaaS-based themes. A lot of these SaaS companies or software as a service, which is SaaS is an acronym for SaaS. SaaS is an acronym for software as a service. A lot of these companies have emerged as very strong growth engines in the last 6 months, purely because there was a huge shift in terms of the way people started working remotely. Now, was this a theme that someone could have picked 2 years before? No ways anyone could have picked it 2 years before, because no one knew about the COVID-19 epidemic 2 years before, right? So there will always be these short-term themes that will be enticing for you to invest in. So you should have a balance of some of these short-term themes which are emerging in the market. You should also balance it with an approach-based portfolio, which means that you should believe that the right approach is invest in undervalued companies, independent of sectors, independent of themes, all of that. So you should have a portion of your portfolio for approach-based strategy. You should have a portion of your portfolio allocated to theme-based strategies, and you should have a section of your portfolio allocated to direct investment. Now, these are stocks that you believe in the story of the individual company, and you believe in the management of the company, you believe in the investment decisions that this management is going to make. So that is typically a way to build a more well-rounded portfolio, is what I would say. I think I'm coming to the end of the questions. Are there thematic sector-wise ETF in US market that we can invest in? Yes, there are theme-based and sectoral ETFs in the US market that you can invest in. In fact, at Global Investing, we are talking to some of the leading ETF companies in the world, and we will be offering some of these ETFs exclusively on the Global Investing platform very shortly. So these ETFs there are over, out of the universe of 3,500 stocks that are available today, there are over 600 ETFs that are available on the Global Investing platform. Some of them are very simple. They're just tracking an equity index, or they're just tracking an underlying commodity. Some of them are more complex. So they are talking about, underlying themes. Like one of the ETFs that got essentially launched is something called as a work from home theme. So they constitute of all the companies which support a work from home productivity tool for the end retail customer. So that's an interesting ETF to invest in. So there are multiple ETFs like that. So there are large ETF manufacturers that work in the US ecosystem, and they keep churning out theme-based ETFs as well. Okay, I think there is one more process-related question. I've already explained that. There's a tax-related question. As I said, I'll come back to that in the end of the webinar. How do you compare with competition? So typically, without taking names, I typically bucket the competition into 2 large or 3 large buckets, right? Global Investing, which is an offering by HDFC Securities, is I think the first of its kind for any bank brokerage firm in India. I don't think any other bank brokerage firm had a completely digital, do-it-yourself, retail investor-focused platform in India till date. Global investing has been first of its kind in India that way. The second thing I would say is, if you were an investor in the Indian ecosystem looking to invest in US markets, even in the last 10 years, if you go 10 years back, you will see there were a lot of international brokerage houses that were available in India, but their focus was not on retail investors. This was largely focused on HNIs. It was largely focused on a portfolio management service. So the access was not easily available for a retail investor. Let's say, as a retail investor, if I had $1,000 or $5,000 that I wanted to start building a global portfolio with, some of these platforms wouldn't even be able to support it from a cost perspective and from a maintenance perspective. Now, that is something that global investing has clearly broken the shackles, where global investing today, even with a $100 portfolio, you can actually remit the funds digitally. You can make a meaningful investment given that there are fractional stocks available in the US. The second set of competition is typically a lot of digital driven platforms that are available. So one thing that one needs to be careful about while evaluating some of these digital platforms is there's sufficient diligence done in terms of the back-end partnerships that are being signed, in terms of the structural arrangements that are there, because it just shouldn't be based on promises that are made over phone calls, but one should do a very close diligence in terms of all the digital platforms that are available, which is what HDFC Securities has done. They've done a detailed diligence on the global investing platform and decided to offer this platform after building it for a period of 6 months, which means that end to end they have tied up the entire fund opening, the account opening process, the fund remittance process, and the investment process end to end through the LRS scheme. So I typically classify competition across these 2-3 buckets, and just as an advice, independent of which platform you go with, make sure that you're always interacting with SEC registered entities in the US market. Whether it is your broker dealer, whether it is your custodian in the US market, just ensure you're dealing with SEC registered entities. There may be a slightly higher cost to this, but in the end, it's also a more safer option. I think there is another question about account opening, which I've already answered. There is a question around minimum ticket sizes for thematic portfolios. Very interesting. So yes, there will be some sort of minimum ticket sizes, but again, keeping in mind the retail investor audience that we are talking to on the global investing platform, these ticket sizes will not be very large. You can assume safely that they will be around the $1,000 mark or slightly lower than that as well. The ticket sizes in terms of that are allowed to invest in these thematic portfolios on the global investing platform. So I think that pretty much covers the questions that we had right now. I think the only thing that I had kept for towards the end was the taxation related question. So let me touch upon it very simply. So if you go to the global investing website, there is a lot of information about taxation as well out there in the form of FAQs. But very simply put, there are 2 things to remember as an investor. One is that in the context of US markets, India and US have a double tax avoidance agreement, which means that as an end investor, you will never be taxed twice for any income that you make. You will only be taxed once. It can be in US, it can be in India, but you will only be taxed once. The second thing is, in terms of the actual taxation, the way it works, there are 2 components to the tax. One is a capital gains tax, the second is a dividend tax. The dividend tax, there is a tax deduction at source that happens in the US. It is a flat 25% tax deduction at source that happens in the US. So for this, you get, so let's say you are expecting a $100 dividend from a company that you have invested in. You will see actually only $75 come into your account. For the remaining $25 that has been deducted as tax, you will get an acknowledgement from the IRS, which is the revenue service, which is the equivalent of the income tax department in India. You will get an acknowledgement saying that $25 has been tax deducted at source for this customer with this investment account, and that tax you can use for your filings in India. This is as far as dividend tax goes. For capital gains tax, capital gains, you are not taxed in the US, which means that, let us say you bought a share at $100, sold it at $110, you will get the entire $110 into your account. So you're not taxed for any capital gains in the US. You're taxed for capital gains in India only when you realize the gains in the US. You're taxed in India. The taxation rates, depending on So basically, this investment that you make in the US market, it is considered as investment in unlisted securities, because these securities are, from an income tax perspective, because these securities are not listed in India. So for taxation perspective, any investment that you make, though these securities are listed in US markets, income tax in India considers it as investment in unlisted securities, and the long-term and short-term capital gains are accordingly taxed based on the tax slabs for unlisted securities. And there is a fairly detailed note that the global investing team has prepared regarding taxation. Most of the basic questions are answered in the form of FAQs on the platform. But if there are any further questions or taxations, I would urge you to reach out to the customer success team at Global Investing so we can answer these questions on taxation. Okay, so I think there is a question saying that some of the European companies which are available on NYSE are not available on the Stockal platform. So it's a slightly technical question. I will explain to you. So for example, there is a concept of ADRs and GDRs, which is American Depository Receipts and Global Depository Receipts. These are basically companies which are not listed in the US, but they are still trading in one of the stocks. The primary listing may have been in some other exchange. It can be in an Indian exchange. For example, Infosys, which is listed on the Indian stock exchange, also has an ADR in the US market. Like that, there are famous companies in Europe which are listed, SAP being one. They're listed in European markets. They also have an ADR or a GDR offering in the US market. Now, not all of these are available for a retail investor to invest, because there are two types of ADR, GDR offerings. There is something called as an exchange listing, and there is something called as an OTC, or the over-the-counter listing. Now, on the Stockal platform, given the rigorous norms that we have, we support only exchange-listed stocks, which means that there is a liquid order book for the stock. There is availability of buyer, and there is enough availability of buyers and sellers on an exchange for these stocks. Those are the only stocks that are available on Stockal platform, and this itself constitutes over 3,500 stocks and ETFs. So typically, all exchange listed stocks in the US will be available on the Stockal platform. ADR and GDR, which is not exchange listed, which is, it can still be tradable, but it's traded over the counter, those are not available on the platform. I think that pretty much wraps up the Q&A session that we have. So thank you everyone for participating in this webinar. Appreciate you taking out your time and attending this webinar. I think this is pretty much the list of questions that we had. Any other questions that you may have, or any other topics that you want us to cover in the future webinars, please do drop us a note, reach out to us. We'll try to cover as many new topics in terms of educational purposes, whatever you need for the US markets. Any queries that you have based on today's webinars, please feel reach out to our customer support help desk, whether you're an existing customer or you're looking to open an account in global investing. Feel free to reach out to us. We'd be happy to answer those questions. Thank you.